Good afternoon, everyone. Thank you for joining this session today. I'm D.Lowery, and I'm the Head of Research Insights here at Preqin. I hope you and your families are keeping well throughout these troubled times. Today, I'll be providing an overview of the European private equity and private debt markets, as well as adding some global context. So if we turn to the slides. For those of you who aren't familiar with Preqin, Preqin are the leading provider of alternative assets data with global coverage across fundraising, performance, deals, and LP and GP activity. We have several hundred research professionals working around the world collecting and collating data on the industry, and the data you see today is a combination of their solutions as well as its global reach. So turning to the next slide, in terms of the presentation today, we'll start off with a global context. Initially, just to provide some market background on the global alternatives industry, and then look a bit deeper into the European private equity market and then the European private debt market. So if we turn to slide 4 on here, what I'm trying to highlight is 3 years of successful fundraising across global alternatives markets. There was an expectation in early 2020 that fundraising would come to an end. But in actual fact, 2020 was much more resilient from a fundraising perspective than many were expecting at the start of the year. As you can see from the first chart here, we have funds raised across the global private capital industry, peaked in 2017. And despite that, we've actually seen fundraising itself, the amount of aggregate capital raised across those funds, across funds raised around the world, has actually been maintained above $1 trillion for the 4th consecutive year. As you can see again from the slide here on the chart here on slide 4, the 2021 year to date has actually started relatively positively. So we have seen a significant decline in the number of funds being raised in recent years, which peaked in 2017. But in terms of where we are now in 2021, we've actually started relatively positively, particularly given the market backdrop that we've been experiencing in recent years.
Yes, absolutely. How are you?
So if we turn now to slide 5. So if we move the slides onto slide 5, what we're trying to highlight here is that AUM has actually increased through and kind of surpassed $8 trillion for the very first time. And here we're looking at all private capital AUM split by the various asset classes. As you can see from this slide here, with the private equity market is still the dominant asset class with more than $5 trillion of global AUM. In terms of what's driving this increase, we're seeing relatively solid performance, and we've also got a significant increase or a significant fund flows into the sector, as was evidenced in the previous fundraising chart. We are hearing from our investor clients that allocations towards alternatives are continuing to increase, and a lot of the reasons behind this are the fact that there are relatively low returns available from other asset classes around the world, particularly when it comes to fixed income markets with so much negatively yielding debt around at the moment. Turning now to slide 6, what you can see here is our investor preference by region. So just the next slide, please. And where we asked our investor clients here which markets they thought offered the best opportunities in 2020 compared to those which they expected to offer the best opportunities in 2025. So we tried to make this as forward-looking as possible. As you can see from this chart here, and so if you can just move on to the next slide, please. We've got North America is actually expected to experience a bit of a decline in interest among investors, and a similar thing here with Europe. And this is a bit of a pivot away from mature markets to those which are growing a bit faster or so significantly less mature. So you can see a significant increase in Asia-Pacific investments, as well as rest of the world and emerging markets. Now, one of the key drivers for this shift is the fact that investors' return requirements are actually relatively stable, and the returns that they're able to generate from more mature markets might be a bit more difficult to achieve in future years. So moving on to the next slide, across the next few charts and slides, I'm going to give an overview on the private equity market. So on this particular slide here, slide 8, what we're doing is highlighting the European market. It was actually relatively resilient when it comes to private equity and venture capital funds throughout 2020. And this actually kind of took many people as a surprise. So we had a continued decline in the number of funds closed, but the actual amount of capital that was raised across those funds was actually a significant increase on the numbers that we were able to deliver in 2019. What's driving this? Well, it could be low returns from other asset classes, particularly fixed income. And if you look at the stock of negatively yielding debt around the world, a larger portion of that is kind of domiciled within Europe. So this could be pushing investors into the higher return asset classes such as private equity. Regardless of the drivers, it does bode relatively well for 2021, and we have started the year in a positive way. Turning to the next slide, what we can see here is the average length of time that the funds that have closed have been spending in market. One thing to point out when we look at these funds closed is that they are spending longer in market, but there is a benefit to that. A larger proportion of funds are now actually achieving capital raising targets over and above their initial target. So as you can see here, the average percent of target size, which is the orange line on this chart, has actually breached 115% for those funds that closed in 2021 year to date, and was actually above 100% for those that closed in 2020. So while these funds might be spending a bit longer on the road, it is worthwhile doing that. Turning to the next slide, I'm looking here at private equity and venture capital deals and exits, and this is on a global basis. There was a huge spike in activity in Q4 last year, when buoyant equity markets helped and valuations across the board were holding up relatively well. This is really encouraging activity. In Q1 2021, our data so far highlights the rise in venture capital valuations, as well deal numbers were down actually relatively significantly. Aggregate deal values increased by a relatively large proportion. This is pointing to a very large scale rise in venture capital valuations. And we've seen this with some of the headline announcements recently. We've had successful IPOs for the likes of Palantir and Snowflake. And then we've had the SPAC transaction with Grab, which was announced this year as well. Turning to the next slide, one of the trends that we've been observing in recent months has been the rise of permanent capital. So larger private equity or alternative asset managers have been carrying out strategic acquisitions, primarily of insurance firms. And this is really good from their perspective because it gives them access to a very large pool of capital, which means that they have potentially less future reliance on their fundraising merry-go-round. It means that there's a pool of capital that's there, it's readily available, not necessarily tied to fund structures. So there could be a significant increase in co-investments on the back of these transactions, but it also means that assets can be held for longer because the pool of capital is much more. We'd expect to see more of these types of acquisitions or joint ventures coming up throughout the rest of this year and into next year. Final slide for the private equity part of this presentation is a quick look at our global private equity AUM forecasts. So the upshot of all the activity that we've seen before, and we're on slide 12, is that we are expecting a significant increase in private equity AUM. These forecasts were published towards the back end of last year and are actually relatively conservative in nature. What you can see is that the 2020 figure that we have there of 4.4 trillion has actually already been surpassed for private equity. We're already above 5 trillion. So we're almost hitting 2021's targets already. And that's with data up to the end of September of last year. So although we're expecting growth of around 15% per year from private equity around the world, it is likely that some of that growth might be front-loaded given the relatively solid performance that we've seen in recent months. So to the next slide, of the next portion, I'll have a quick look at the European private debt markets, providing a broad overview of activity. So the next slide is looking at European-focused funds, which raised $37 billion in 2020, and that was actually down 28% year on year. So from a European perspective, the private debt market has actually been a little weaker than the overall global numbers. This pattern, however, isn't significantly out of place and has been repeated in the past, so it's unlikely to deter long-term investors. If anything, it could mean that competition in the European market could be reduced slightly, with fewer firms competing for deals than in other markets. So this might actually be positive for overall returns. Turning to the next slide, what we do here is highlight investor plans for their allocations to alternatives by asset class. So as you can see here, a significant proportion, so 67% of private debt investors plan to increase their allocations over the next few years, with 16% expecting to significantly increase allocations, second only to private equity investors. This is central to our solid growth forecast for private debt as an asset class. Turning to the next slide, what we're highlighting here is the ongoing trend for capital consolidation or capital concentration. Private debt is actually one of the most concentrated asset classes, and just 21% of capital raised in 2020 was secured outside of the top 50 funds. That's the lowest since 2014, when the asset class was still going through a significant period of evolution. This isn't something that we expect to reverse anytime soon, but what we're hearing from our investor clients is that there could be in future a greater desire to allocate to smaller or more emerging or more niche managers in the future. It's very easy to keep allocating to the large funds and the large managers because relationships that are already in place. But I think in terms of the smaller and more niche managers, this is where a lot of the innovation within global markets tends to take place. And certainly from what we're hearing, there's a real desire for allocators to try and capture some of that evolution in the market or focus more on a very specialist manager. Whether this will play out in the second half of this year or whether that'll be a 2022 story still remains to be seen. When we look at the private debt, the key challenges and opportunities, we ask here similar questions to our fund manager and our investor clients. So when it comes to investors, things they're concerned about are the geopolitical landscape, interest rates, deal flow, and asset valuations, whereas fund managers tend to be much more concerned with the competition for assets. And we're certainly seeing this across some types of investment. So if you look at the chart on the right here, we've got distressed debt is the strategy that investors view as presenting one of the best opportunities in the next 12 months. This is actually a little bit at odds with how the market's evolved, because by the end of Q1 last year, many people were expecting markets to experience significant distress and dislocation. But because the sheer scale and speed of government and central bank intervention around the world, there is little, well, I suppose the window of opportunity for distress particularly was closed very, very quickly. So although investors do feel that there might be opportunities, deploying capital within distress or even special situation strategies could actually be relatively difficult. And again, if we turn to the final slide in the presentation here today, what we're actually kind of showing here is that all of these things considered, private debt does remain an asset class that is very much in demand for investors around the world. We're expecting growth in AUM to accelerate compared to what it was between 2010 and 2020. And the 11.4% growth rate that we're targeting here out to 2025 is second only to private equity among all of the alternative asset classes that we cover. We do feel that there could be some short-term challenges to the growth of private debt in the market in the next year or 18 months. And we've seen this borne out in Q1 numbers, which have just been released in line with the Preqin's quarterly updates. So we've seen investors tell us that they're worried about the inflation outlook in future and that they might be kind of just sitting on the sidelines temporarily just to see how that outlook evolves. So it's something that we are watching very, very closely. But what I would say is that the private debt market, not only in Europe, but around the world, is in a very, very good space. So that was a very, very quick run through of the private debt and the private equity asset classes in Europe. Come to the end of the presentation for today. Thanks very much for listening, and I hope you enjoy the rest of the conference. Really appreciate your time today, so thank you.